Okay, perfect. Hi everyone. Thank you for tuning in. I'm Sergel Woldemichael, a wealth management analyst at GlobalData, which is a data analytics company, and I will be the host for today's very exciting discussion around robo-advice. In particular, we'll be touching on teaming robo-advisors with wealth managers and really just trying to decipher what the recipe for success is in robo-advice. So touching on the needs for robo-advice, looking at, I guess, lessons from those that have come and gone over the past 10 or so years, looking at the very sought after hybrid robo-advice model, and just really what the future holds for robo-advice. We will be taking some questions towards either the middle or towards the end if there's time. But firstly, what I'd like to do is allow our very special panelists to introduce themselves before we get into the questions. So maybe, Mario, could we start with you?
How fortunate, me beginning before my customers, but yeah, I'll take the lead. My name is Mario Alves. I'm heading the custom engagement part of aixigo. aixigo is a wealth tech firm. We provide solutions such as robo-advice, a term that I actually dislike, to be honest, to provide them to financial institutions in UK, Germany, Austria, Switzerland, Liechtenstein.
Perfect. And maybe Kalle?
Well, first of all, thank you for having me here today. It's a great pleasure and greeting from Finland. My name is Kalle Anttila, and I will be adding the Nordic flavor to this discussion. And along the years, I have had the opportunity to actually work on both sides, both sort of designing a robo-advisory as part of value proposition, as sort of a holistic value proposition, as well as I have worked during the past years in the frontline trenches, helping out clients on complex investment advisory needs with my team. So I have this sort of a background of both the service model kind of a thinking as well as then the human touch from the front line. Thank you.
Perfect. And Dean?
Yeah, I'm Dean Mullaly. Been in the industry 35 years as an independent financial advisor, as a sales manager and senior sales manager, and worked for most of the 5 major banks before setting up Mark Dean Wealth Management in 2010. And since 2010, funny enough, I got involved in another project with a couple of other people looking to build a direct-to-consumer platform, which kind of included a robo-advice part as well. So I'm kind of aware of all the major players in platform building and technology and keep a close eye on how it develops and things like that. So I've kind of got just a keen interest on the side, if you like, to normally run in my IFA business, but also into the development of technology in financial services in general.
Okay, perfect. Great lineup here. So no further delay. So around the first question, really, I think as we know, robo-advice was really birthed, I guess, off the back of the last crash in 2008, and it's expanded in so many different ways since then. But what would you say is, when it comes to robo-advice, I guess, with this COVID-19 pandemic / coronavirus crash, what has been the real impact for robo-advice post-COVID-19? And maybe we start with Dean.
Well, you know, it's no secret that obviously people have got more time on their hands sitting at home and doing things on their own. Equally, it's kind of no secret that as an IFA firm ourselves, we have embraced obviously the use of technology even before the pandemic. But since the pandemic, we are a new sign up to Zoom. So we signed up to Zoom, and we're doing obviously a lot more of our client meetings, or all of our client meetings, over the internet. So I think what it's done is it's forced the whole adoption of technology in financial services further along the line. Whether that is good for robo-advice is a completely separate question, because it comes down to an element of trust and whether people, you know, want to just do something on on the internet without any human reaction, and there is the crunch question. It's the element of trust. But in terms of adoption of technology, yes, I think not only us as in the financial services industry have we had to carry on our businesses, but I think generally the public have done that, in not just in financial services, but in a lot of other areas. Probably people that didn't even order from Amazon pre the pandemic have now, with the shop shut, been forced to order from Amazon and maybe they're kind of thinking, actually, this didn't work too badly. It's gone quite well, So there will be changes in the way that we shop and we do everything with using more technology going forward.
And Kalle, if you wanted to add to that.
Well, certainly, I think it was quite remarkable from this sort of a human advisor point of view. Last year, actually, everything happened overnight. We were face-to-face operation, and then after one night, we were operating from our homes directly to the digital channels towards the clients. So one could argue that the gap between the sort of a more traditional advisors and robo-advisors has sort of decreased along this past year, because we are operating in a sort of a same environment as such. And I would fully agree on the ideas presented on that people have more time on their hands, and certainly, for example, in the Nordics, there's been a big boost on investment savings market as well, that people are really interested in these topics. So advice is needed, and therefore, at least if look at, for example, Ernst & Young came out with a study about the Nordic market on digital advice, and they said that the market actually increased sort of asset-wise 43% last year, and 30% more clients than previous year. So certainly there's a huge demand for these services, and they also expect that this will continue. So probably the pandemic gave a good boost on these services as well, on sort of getting traction towards the clients.
Great. And Mario, your view?
Really a lot has already been said, so I would like to add two actual customer situations of ours. On the one hand side, we have a large D2C business that embraced the idea of advice also, but went from sort of a two-channel approach to a multi-combined channel approach through that force that came with the pandemic. Also embracing the idea of through enabling the customer, also enabling the customer to choose, does he want to have let's say, full personal advice driven by an advisor just being used through digital means, or he wants to have some kind of semi-automated advice for a lower rate, or he wants to have a full auto advice for an even lower rate. So giving the customer even more choices to do advice. And that has actually happened in the UK with a cash flow planning experience. On the other hand side, we saw in a continental European player having loads of branches, not being able to use those branches anymore, being forced by cost reasons to close down branches, to ask themselves, well, how we are going to do advice, how we are going to provide advice to people that couldn't handle or that couldn't pay off of an advice through their AUMs. And that led to a real, not discretionary portfolio mandate style advice, which you often find in robo-advice, but through a real robo-advisory driven process. So when you look at the MiFID, you've got your self-directed, you've got your advice style, and you've got your discretionary. What you most of the time see is a discretionary portfolio management, but they are now currently going for a real advice proposition being done by engines provided by us, being driven by their banks parameters, but in the style of real advice. So I think the pandemic not only had a shift towards being more digital, but it also through the influence on other factors is pushing the industry towards how can we use technology, and technology standing for robo-advice and such, to reinvent the business models as a whole. Seems to be the thing that I could add.
I think that is a really good point, and also this pandemic situation last spring also noted out quite clearly the weaknesses in this purely human approach. If you think about the normal advisor might have from 100 to 200 clients, and there's a huge dip in the market, which causes a lot of stress among the customers. So how can you actually be in contact with all the customers and having these sort of peace of mind discussions with them so that they would actually keep their investment strategy and not starting selling securities at the worst possible moment? And I think that is, again, in this situation, it shows that the human advisor has really good benefits on having these emotional discussions with the clients, but the question is how we can create a lot more scale in these, because we can't contact all the clients at the same time because it takes time to actually have the discussion, think about how the situation has changed, if it has, and then what will be the actual proposal for them. And it's time consuming.
So I might want to weigh in with 2 sentences on that. There is a term going on. I just saw it in the UK, but I think it's going to be adopted. I think we're turning from robo-advice, which is the RoboCop, which is and actually the RoboCop has never been a RoboCop. It has always been a bionic cop, because there's a guy inside that uniform. And if you think about the $6 million man, which was from the 80s, maybe you know, I think we're talking about bionic right now, because the situation that Kalle mentioned is exactly the situation that I think. You've got that huge pressure on the advisor, and the bionic part of it can now relieve that by giving all the customers the message, okay, we got it covered, send that out 200 times individually, and then the advisor can take that piece by piece and work on that. And to me, I think the bionic idea of it is pretty intriguing.
Perfect, because I like the bionic term. So there's really kind of 2 things I want to further expand on off the back of your responses there. We will touch on kind of the hybrid bionic model, but just firstly, I know obviously how COVID has really accelerated digital transformation. Do you feel as though now, especially with COVID, do you feel as though robo-advice has become almost a must-have rather than a nice-to-have amongst traditional wealth managers and private bankers, especially in this kind of digital transformation period? Dean, do you have any views on that?
I don't think it's necessarily a must-have. It depends upon what your business is. I think, you know, if you, I mean, I haven't seen any surveys on this, but I would imagine the adoption of digital is more for the younger age generations. The older generations are still in the old style of wanting face-to-face and wanting human contact. So I think it's still a progression that's going to take years and decades to go through. And I think technology as well still needs to adapt and get better and become more gamified and more engaging. And, you know, I think, and of course, the unknown on the side of that is regulation. If regulation starts to clamp some of that technology so you can't use it, you know, regulation can put a halt to a lot of good ideas, unfortunately, you know, because it's assessing market risk. And, you know, if it runs away with something and then you find out 10 years down the line, actually, we shouldn't have done that 10 years ago. You know, that's what the regulators always worried about. So, you know, direct to consumer platforms such as here in the UK, like Hargreaves Lansdown, have got a very good monopoly, a very good foothold. They're good at what they do, you know, and they offer sort of their own model portfolios for client to do. And I come across quite a few clients that have done it, but there's no real human interaction there. There is if you want to pick the phone up and ask a technical question or something, fine. But that's for people that are reasonably confident financially that they know what they're kind of doing or think they know what they're doing. Most people that have got money are in their 40s, 50s and 60s, and that generation tend to want human interaction. Yes, they don't mind a good digital platform to do it on, but they'll still want to be able to pick up the phone to someone that they trust to give them, you know, verbal advice.
And Mario, yeah, of course.
Yeah, I want to end because there was a commentary on disagreeing with Dean. I want to jump to Dean's side, but on the other side, Lucy, you're both right. When 50s, 40s, 50s, or 60s customers think about their financial situation, it's not about them not wanting to use some kind of robo-assistancy or something like that, but the element of a personal evaluation or a personal sort of sparring partner in things does become more relevant. And I think that's not I'm not going to start a generation battle on this, because you can have them on all the sides. So it could be for anyone. It's about how the customer takes up decisions. So it's about decision making, taking, and all the behavioral stuff that you have. And some people are younger and need somebody on their side, and some people are older and just need some assistance. There is no clear there, and I think that was the thing that the point that you wanted to make, right?
Yes.
And Kalle, if you want to add to that at all?
Well, I would have to agree that nothing is must. I think the issues that what questions we are solving for the company in particular over here, and what is the sort of a point of departure for this interesting exercise over here. I come sort of from the more traditional private banking side of the business, where we saw that with the sort of one size fits all approach, meaning everything is tailored, very time consuming, is not the perfect fit for all kinds of customers. The world is muchly created in, for example, Finland through entrepreneurship. And the guys and girls are really busy in building their companies, and they don't really have time to talk to instant advisors as such. They want to sort of handle their stuff whenever it's sort of suited for their needs and calendars. And we saw that this more digital approach would give the possibility to sort of cater these for these clients, and also sort of make a differentiation between what does it mean to actually do this online only, and then with the advisor. So you can actually have the discussion that what is the service that you're actually requiring, and it has an effect on the pricing as well. So it becomes the sort of a value-based pricing topic if it's sort of incorporated in the value proposition. So as such, probably not needed in all of the cases. I've seen that in Finland, for example, couple of the really high quality private banking operations, they actually have bought up these startups in the first place to actually buy in the experience, the processes, so that they can actually scale that towards the other businesses. So you need to sort of have that scalable platform in order to fix the unscalable issues that they currently have with their sort of a high-end client base. So I think probably you don't need to have the robo-advisors as such, but if you're not mindful about how you run the operation, how you sort of fix the cost to serve issues, it will be bad going forward. So you need to be mindful, at least towards the tech issues here, how you actually utilize the services in building your business.
Perfect. And just to kind of even add my own two pence to that, because we do look at data and analytics and surveys, and what we do kind of see that the older generations, of course, lean more towards kind of a human face-to-face interaction. The younger generations more digital, but it's scattered. It's not so separate. And the real main thing is that everyone wants a good experience, and if you want to provide a digital experience for an older generation, they're not digital natives, so it has to be relatable for them. So yeah, I completely agree with your points. So yeah, I thought I'd also I guess we can kind of stay on the hybrid kind of point really, and the bionic point, if Mario wants to expand on it. Is there anything else that you thought you'd touch on from the hybrid bionic?
Can I just add one other thing as well?
Yeah, of course. Yeah.
I said about technology actually catching up, and technology is still going through its journey as well, because as we know, technology doesn't stand still. And whenever, several years ago, we were looking at building our own platform and our own direct-to-consumer platform, and it was ridiculously expensive. Then we looked at it a few years after, it was about half the price. And funnily enough, we looked at it about a year and a half ago, and it had gone down even further. And now you can get technology off the shelf, which is a lot more cheaper. But the thing that's prohibiting us doing that is client acquisition, because the costs of client acquisition are absolutely huge. So it doesn't really come down to the cost of technology in the end. It comes down to the cost of client acquisition. But what I would say is that the technology needs to actually improve as well, because just recently we've been looking at trying to get a decent client reporting portal where we can have all our existing clients' assets and things on there, and price feeds and things like that, and even finding one of them at a reasonable cost for a medium-sized independent financial advisory business like us is hugely expensive. And I just don't see why it's that expensive, to be honest. To some extent, a lot of those licenses from the stock markets are huge. They're like a law unto themselves in terms of the pricing they charge. The data feeds are hugely expensive, and again, they're a law to themselves in terms of what they charge. So it's all of that. In some ways, the regulator needs to get hold of those other areas and regulate them more, because otherwise other developers can't develop those necessary technologies and platforms, because there's an unknown liability potentially in the future where these other things could increase their cost 2, 3, 4, 5 times fold, and they haven't built it into their plans. So I think the whole technology world needs to develop much more until it becomes wide use in most advisory firms, most investment firms.
Okay, great. And Mario and Kalle, if you have any other points around hybrid robo-advice, feel free to express them.
Oh, well, it's actually more about what Dean said. Interesting topic, because, representing a technology vendor, and I think the whole thing, or what we currently see is sort of a squeeze out situation, not only in terms of technology, but also in terms of firms. There will be a situation where some of the big shots will have the money to allow themselves for individual reporting, individual advisory processes, and things like that. And you need to have a large group of customers already at your hand, so you need to be a large incumbent to do so, which is fine. On the other hand side, if the mid-sized firms will either find a way to run those larger stacks on their side, or we'll have to find ways to utilize technology offerings that are more sort of mass affluent style offerings, if I would say, because it's not looking great, but it's fair enough to provide that to the customer, and you can always add your personal flavor in the advice and how you do it. But there is sort of a squeeze out situation as well. And on the vendor side, it's the same. You either want to go towards a business where you provide individualized, still cloud running solutions, or where you go to a sort of a off-the-shelf, really standardized solution for those other possible customers. That's the sort of split that I currently see. So what's happening with the customers, what's happening with the firms, is also happening with the vendors. That's currently the game. And that's being pushed actually by that's a digitalization trend, because it's exactly the trend that you see with other services or even the manufacturing. You either go for the IKEA or you go for the, I don't know, I'm not into exclusive furniture, but whatever is exclusive furniture, you either go this or that, something in the middle, just not happening anymore.
Okay, and just a bit conscious of time, so kind of one question to try and round up before we look at maybe some audience questions. Just to very shortly, what does the kind of ultimate wealth manager and robo-advice partnership look like to yourselves? Maybe Kalle?
Yeah, this is probably quite unconventional way of looking at this topic, but I would, as a Trekkie fan, say that the ultimate partnership would probably look like something like Captain James T. Kirk meets Spock kind of a partnership, where there's sort of a emotional intelligence meeting the logical wisdom and discipline of Spock. I think that would be sort of my dream combination.
I like it.
You may.
I like it. And Dean, what would you say is kind of?
I can't come up with anything as fancy as that. I am a startup. I am. I would say, you have to adapt your business and your offering to your client base ultimately, because it is a people business. But the thing that I'm still searching for is a very good client reporting portal, because I'm fortunate enough that I don't necessarily need to scale my business up any further than it probably already is, so that's fine. And we look after high net worth clients, so they kind of want that personal interaction. What I'm lacking is a really, really good white labeled client reporting portal at a reasonable cost. There are some out there, but they're just not a reasonable cost for our size of business. So and I can put other assets on and we'll track the prices and things like that, because I think that's what clients want. They want to be able to kind of talk to me whenever they want, have an annual review, but at any time, 365 days a year, log into a white labeled portal that's going to tell them what the value of their offshore bond, their ISAs, their pensions, or whatever it is that they've got on there. And so they can see it all in one place. And I don't think it needs to be any more complicated than that, to be honest.
Great. And Mario, maybe if you want to sum up what you think the ultimate experience is.
The ultimate experience, I don't know. I thought the question
partnership.
was the partnership, yes.
Partnership, yeah.
I predict that we will see a lot of typical B2C robo businesses die, because they are not, customer acquisition costs are still too high. They're not making enough money. Some of them, and they're already trying to do a B2C style of business. Some of them will turn to try to get to be a B2B, so to become a software vendor, maybe as a business process outsourcing deal. But the ultimate situation will, in my view, be that you either have smaller to mid-sized institutions working together with business process outsourcing, people providing the software and all the other processes to sort of have scaling costs. And you have those larger incumbents that will either buy or build their robo-advisory solutions, not only for the investment part, for all of it. You will see cash flow planning, you will see DB pension discussion topics being provided by engines. You will see asset allocation discussions supported by the engines. You will see and we'll see all of that in the market. So basically, 2 turn points. One will go to the more business process outsourcing style of things for the smaller to the mid-sized firms. Larger firms will tend toward buying or building solutions on their own.
Okay, great. And I think we have 2 minutes left. So just a very last kind of on-trend, recent trend topic that I've seen. Let's probably wrap it up. Let's just say, looking forward, a very classic question: where do you really see robo-advice in maybe the next 5 years, or by the next financial crash? Do you see it cemented, or do you see it continuously kind of evolving as technology evolves?
I'll go first, actually. Your final point there, I see it evolving. I see it improving. I see it probably being adopted more. Cost has got to come down, which it will do just with competition anyway, I think. And I think more advisors going forward as the younger generation of advisors, which obviously there's not enough of coming into the industry, but as there'll be more adoption because they're more used to technology anyway, and they'll automatically include technology as part of their offering. And I think the younger generation as well, but will adopt more of it to do their investments on. But it's going to take time. It's not going to be a quick thing. The next 5, 10, 15 years, it will keep progressing. It will naturally progress. Perfect.
And Kalle, I know we have 1 minute, but if you could sum it up.
Well, I believe that it will be adopted a lot more broadly in the sort of funds industry altogether, and there are really big drivers that are not sort of ending quite soon. For example, thinking about the banks who are offering these services to their clients, there will be cost pressure going forward, and they need to find new ways to distribute the services to clients. So it will be absolutely there as well. So I believe it will live long and prosper.
Perfect. Mario, are you agreeing?
Yeah, I'm the may the force be with you guys. So yeah, and I think the incumbent side will win. If this is the dark side or not the dark side, it's up to you to decide. But this is not going to break the incumbents. They will suck this up again, and they will put that into their offerings, and there will be no totally robo-revolution. I'm sorry for that. I'm sorry for all the guys invested in that, but we'll have to, the incumbents will work with this, and that's the thing.
Perfect. Honestly, amazing. Big thank you to Mario, to Dean, and to Kalle. I think hopefully for the audience, that's been an exciting discussion to listen into and get more of an understanding of where robo-advice is likely to go, and just really deciphering what success looks and the future of the space really kind of looks like. And yeah, I think we're on time. Good to end there. Thank you very much.
Thank you.